In this episode, the Trump tax cuts are here, and we got some of the highlights for you. Hey everybody, I'm Mike Desepoli, and this is episode 19 of the Ask the Advisor show. The Trump tax cuts are finally here, and today we got some of the highlights that investors need to know about. You know, this is probably one of the most long-awaited tax reform proposals of all time. It's all we've been hearing about since Trump got elected. Obviously, the stock market has been anticipating this very anxiously. There's been a lot of upward movement in the stock market over the last couple months, and we think the primary catalyst for that rally has been the proposal to cut taxes. So now that the actual proposal is on the table, let's take a look at a couple of the details. First, on the personal income tax side. The Trump administration seeks to simplify the tax code by eliminating the 7 income tax brackets that we currently have and replacing them with 3 brackets. 3 brackets will be 10%, 25%, and 35%. And obviously this seeks to simplify the tax code, to create less guesswork as far as where you will end up on a year in and year out basis, what your tax liability will be. And it should make tax planning in conjunction with your accountants and CPAs a little bit easier as well, because now there's not as many brackets that you could potentially fall into if you're somebody that has a varying income from year in and year out. Another area that this reform focuses on is deductions. First, for the deductions that will not be touched. Thankfully, deductions for contributing to your retirement accounts will remain, and we're very happy about that. We want to incentivize people to save for their retirement. We think it was a very dangerous concept to take away that tax deduction, because as it is, 64% of Americans are already underfunding their retirement savings. And if you take away the deduction, which is the incentive to save for your retirement, we think those statistics will get even worse. So we're very happy to hear that those deductions will stay. They're also going to keep the deductions around home ownership, which is a little bit vague at this point. We don't know exactly which ones they're talking about, but nevertheless, it's always good to have tax deductions tied to home ownership, because it encourages people to step out, purchase a home, and go that route, which stimulates growth here in our economy. For investors, capital gains taxes will also be changed. There will be a reduction in capital gains taxes, which is the taxes that you pay on money you make in your portfolios, dividends you receive, interest payments you receive maybe from a CD at the bank or a savings account that has a yield on it. They're going to reduce capital gains taxes by 3.8%. So why 3.8%? Well, currently, capital gains taxes include a 3.8% tax on top to fund the Affordable Care Act. Now, many people don't even know that. So if this is the first time you're hearing that, don't shoot the messenger. I know it sounds ridiculous that your investments are funding the current healthcare law, but nonetheless, they're going to attempt to wipe away that 3.8% tax that sits on top of your investments. Obviously, we're very happy to hear that. It means more money in investors' pockets, particularly retirees who use their portfolio to generate income to maintain their lifestyle. That'll be another 3.8% that they'll be able to put in their pocket, which again, more money in your pocket, more discretionary spending, better quality of life, and it pushes the economy forward. So we're very excited about that. Now for the corporate side. We don't have a lot of details about corporate tax reform yet. All we know is the basic rates. They want to cut our corporate tax rate from 35%, where it currently is, which is the highest corporate tax rate in the world, to 15%. Obviously, that's a big tax cut. We're very excited about the prospects of what that may bring. What it would allow is to make our business environment a lot more competitive with the rest of the world, perhaps entice companies to bring their operations here to the United States to grow and expand, which would bring more jobs, more money flow, more economic stimulation. It's really a win-win across the board. Now, there's talk that they may look to eliminate certain deductions for corporations to try to make up for that shortfall of tax revenue. We're really not sure what that's going to look like, so we have to give it some time for more details to roll out. But another proposal around corporate taxes is something called repatriation. Repatriation is the concept of inviting corporations, U.S. corporations that hold tax dollars overseas, because they're in safe havens where they're not paying high 35% corporate tax rates. We would give these corporations an opportunity to bring that money home, pay a reduced tax rate, and keep that money here on the U.S. shores. Now, currently it's estimated there's about $2 trillion that sits offshore in tax havens, and if we could even get half of that to come back to the United States, that would stimulate a tremendous amount of growth, and obviously that tax revenue would be used to bridge the gap and fund these new tax cuts. So there's really a lot to be excited about. Obviously, we think a lot of this movement in the market recently is due to the concept of cutting taxes. So the stock market was very anxious for this reform proposal to come out, and so far it looks like the market is pleased at what it sees. Now, looking forward, how long will something like this take to implement? Well, we know anything on Capitol Hill takes a little bit of push back and forth before it goes through. There's definitely going to be some renegotiation of this proposal. I don't think Republicans and Democrats ever agree on anything the first time around, so it's definitely going to take them some time to iron out some of the kinks. We think the timeline of getting it through this calendar year is still in place. August may be a little bit premature, maybe looking a little bit more like the fall at this time. But again, we're going to take this one step at a time and see how these things develop. If you have any questions about how this new tax reform proposal will affect you from either an individual standpoint or from a business standpoint, feel free to reach out to us. We'd be happy to answer any questions that you may have. And also how this will impact you, your investments in regards to the capital gains tax rate being cut. We're happy to address any questions that you might have. And anything else that you might want to talk about in the investment world, please. That's the whole purpose of the show. We're happy to answer the questions that you have. You can send us an email, info@asktheadvisor.com, or visit us on Instagram using the handle @AskTheAdvisor. We got a lot of really interesting stuff we post there, some different economic and finance tips, some motivational things for entrepreneurs, things to get you in the right financial mindset to achieve your goals. And of course, tweet us using the hashtag #AskTheAdvisor. Any question that you have, we'll be sure to answer it here on the show. We love to do it for you. We always enjoy sharing valuable insight with members of the investment community. Thanks for watching, guys. We'll see you back next week for episode 20.